Just a second. Okay, I think we should get started, and Isha can join us when she can. Okay, now think about this. So, what is this question saying, right? So, the economic outlook for Japan. In 2017, the forecast of the Bank of Japan, the country's central bank, was that Japan's economy was likely to enjoy moderate growth, right? It is, right, in 2017, the Central Bank of Japan had the expectation that the country is about to enjoy moderate growth. Domestic demand was likely to increase due to spending in both the corporate and household sectors. So spending was increasing by firms, which is investment, and household sectors, which is basically the consumption that was also likely to increase. Expansionary monetary policy and fiscal spending by the government had produced a large scale stimulus. Expansionary monetary policy, as we know, what is expansionary monetary policy? Expansionary monetary policy is when you reduce your interest rate. So when interest rates are being reduced, that is expansionary monetary policy. So Isha, we just started reading the case study. Let's have a look at this. So this is, what year is this, right? So this is October, November 19, right? Relatively new one. So the economic outlook for Japan. So what is this case study saying? Let's read it together. Okay. In 2017, the forecast of the Bank of Punjab, the country's central bank, was that Japan's economy was likely to enjoy moderate growth, right? Domestic demand was likely to increase due to spending in both corporate and household sectors, right? So domestic demand, which is aggregate demand, is expected to increase due to increase in corporate spending, which is basically investment, and household sectors, which is the consumption in the economy. Expansionary monetary and fiscal policy spending by the government had produced a large scale stimulus. Now, if you remember, we did talk about expansionary monetary policy. So expansionary means to expand the size of the economy. When you want to expand the size of the economy, you reduce your interest rates. So this is expansionary monetary policy. And what is expansionary fiscal policy? That you reduce taxes. So you reduce taxes and you increase government spending. That is expansionary. That is expansionary fiscal policy, right? Okay. Is this making sense? Right? Okay. Now, this being said, we'll move on and keep reading. Okay. Later on, it says that as part of Japanese government economic strategy, progress was expected in overcoming deflation through quantitative easing. Interesting, right? So we did do a case study on quantitative easing before as well, right? And we will be able to discuss it over here as well. So the government economic strategy, progress was expected in overcoming deflation. As I did mention, I do mention in class from time to time that Japan is the only country that has, right, that has inflation, right, that has deflation, sorry, right? Okay, now this being said, right, through quantitative easing. What is quantitative easing? I'll explain you. So if you don't know, Arbab, I think you were not there in that class. So what is quantitative easing? It's a very simple and easy concept. We did talk about the open market operations. Did we or did we not? Right? So if you remember, by talking about the credit multiplier, we talked about the concept where the commercial banks buy government securities and sell government securities, and in the process they affect the money supply of a country, right? So quantitative easing we're talking about. Now, if you remember, we talked about open market operations. What is open market operations? Open market operations is when the commercial banks of an economy buy and sell government bonds to affect the country's money supply, right? So basically there are two steps involved in open, there are two processes or two things that commercial banks can do. One is to sell government securities or government bonds, as you want to say, right? Bond securities, same thing, right? So sell government bonds. And the second step is to buy or purchase government bonds from the public. So sell government bonds to the public, purchase government bonds from the public, right? Now, as Isha was saying earlier in today's class, that when you sell government bonds, when initially you sell government bonds, what would that do? Now, try to understand the process. When you sell government bonds, who buy government bonds? Firstly, tell me this. When commercial banks are selling government bonds, who is on the other side of the transaction, right? Who is on the other side of the transaction? Obviously, the general public. So they will buy bonds. When they buy bonds, their cash is given, their cash moves out of their bank accounts into the government bank account. So if I buy government bonds, my money from my bank account will be deducted and that money will be channelized to the government, right? So exactly, private people, public or households. Very good, excellent, right? So when that happens, because this is the entire process, right? So there's bank, right? There's government. So government is selling bonds to the public or household, if you want to say, right? So bonds are going in this direction, right? And in exchange for those bonds, obviously the public is paying the money to the government. The public is paying cash or money to the government, right? So now less cash is available in banks, right? Less cash is available in the banks, right? Because where was this cash or money lying previously? In the public's bank accounts. Now, when banks have less cash available, they can issue less loans. When banks have less cash available, right? Money available in the banks, right? They can issue less loans. So therefore, what happens? Less deposits in bank means less loans issued and higher will be the interest rate. What will that do to interest rates? Right? Less deposits available in banks. Am I making sense? Right? Because obviously bank's ability to issue loans is based on how many deposits you have. Less deposits available in bank, less loans and higher interest rates. So why higher interest rates? Because obviously if less amount is being lent, interest rates will be higher and higher interest rates. Any confusion so far? Anything that you did not understand? Students, are you following me? And now we'll reverse this. Now, on the second side of the equation, when you purchase government bonds back from the public, purchase government bonds. Students, follow me, right? Purchase government bonds. So you do the opposite thing. Now you have to pay back the money to the public, right? So there would be a bank involved, right? Like always. On one side of the transaction, you have the government. On the other side of the transaction, you have public, general public, household, right? Now, the bonds will flow, right? The bonds would be flowing, sorry about that. The bonds would be flowing from the public to the government. Do you agree with me? So bonds would be flowing from the public via bank to the government, right? And where would cash be flowing? Cash would be flowing in the opposite direction. Cash would be flowing in the opposite direction. Cash would be going from the government bank account to the public's bank account, right? Now what happens? Now, obviously more money becomes available in the banks, right? Right? More money available in banks or more deposits, whatever you want to call, more deposits available in banks. Now, what would this do to the, would that increase the money supply or decrease the money supply, right? More deposits available in banks, which means more loans available in banks, which means more loans and therefore lower interest rate. Easy. And therefore lower interest rates. So this is what you need to understand, right? So this part of the transaction where you are purchasing back the government bonds and that is reducing interest rate, this part is known as quantitative easing. This part, the second part, is known as quantitative easing. Arbab, does it make sense? Right? Right? No. What did you say? What increase? Sorry, I just read your comments right now. So money supply will increase, more loans, and loans have inverse relationship with interest rates. Do you remember we talked about this, right? Loans, the quantity of loans has inverse relationship with interest rates. Why? Because if you remember, we talked about loanable fund theory. So loanable fund theory was one of the two, you know, theories that we discussed of how interest rates are determined in an economy. So on the basis of that, what we learned was that just like any other, product, interest rates are determined on the basis of demand for loans. So downward sloping will be the demand for loans and supply of loans. So who determines supply of loans? Obviously the banks which are issuing loans. And who demands loans? People like you and me, and banks, sorry, you, me, and businesses who want to borrow money to invest in their ventures and so on, right? So where the demand and supply of loans intersect, that is where the interest rates in the economy are. That is where the interest rates in the economy are, right? So that is what it is. So when money supply is increasing, you can see for yourself that when the money supply increases, which means more loans being issued, right? That would do what? That would lower your interest rate. So this is the entire concept that you need to know. And therefore, this part is known as quantitative easing. This part is known as quantitative easing. Increase in money supply increases aggregate demand. Isha, increase in money supply. In some cases, increase in money supply can increase aggregate demand, but as we have just learned that usually, right, it will increase aggregate demand to some extent, but that causes inflation, right? So that causes inflation. So when money supply is being issued, when more more loans are being issued, people will have more purchasing power. When they will have more purchasing power, they will demand. So aggregate demand can increase. And as the result, yes, aggregate demand in fact will increase. Aggregate demand will increase. And as the result, since aggregate demand is shifting upwards or rightwards, that will result in higher price level. That will result in higher price level. So students, are you absolutely clear on what quantitative easing is now, right? So I explained you in so much detail because there has been a couple of case studies in which you were asked about quantitative easing. So I thought it's important that you should know everything in detail, right? So quantitative easing is, part of open market operations. What is open market operations? Open market operations is the process how commercial banks buy and sell government securities to affect money supply in an economy. So there are two sides of the transaction: sell government bonds and purchase government bonds, right? So when you are selling government bonds, this means that cash is moving from public to the government, and less loans will be made. And when less loans will be made, higher will be the interest rates, right? So in this case, when you are selling government bonds to the public, there will be higher interest rates as the result. Long story short. On the other hand, when you're purchasing back government bonds, so bonds are coming back from the public to the government, and in exchange, the government is paying them the cash. Now this cash becomes available to commercial banks. So more deposits are available in banks, which means more loans will be issued by banks, and therefore the interest rates will be lower, right? And when the supply of loans increases, as we saw in the graph, right? So the interest rates in the economy will decrease. So this purchasing of government bonds is known as quantitative easing. What is this called? This is known as quantitative easing. Any confusion, students? Are we absolutely clear? So quantitative easing simply means when interest rates are decreasing because supply of loans have increased. So supply of loans have increased, and therefore interest rates have decreased, right? Okay. As part of, have a look at this. So as part of Japanese government's economic strategy, progress was expected in overcoming deflation through quantitative easing. Supply side measures induced regulatory and institutional reforms. Regulatory, right, to make regulations, and institutional reforms increased labor participation by women, and elderly, and support for firms in their efforts to improve productivity, right? So on one hand, the government was using quantitative easing to fight deflation, right, which is opposite of inflation, you know that. On the other hand, the government was also using supply side measures. What is supply side measures? We did talk about this in class in detail, especially in AS. Supply side policies are any strategies used by the government to increase the aggregate supply of an economy. Strategies used to increase the aggregate supply of an economy is known as supply side policies. And what do you do in that? Think about this. So they're trying to increase labor participation. They want more women and elderly to work in the labor force. To support firms, the government is supporting firms to improve labor productivity, right, to become more efficient. And the government also introduced regulatory and institutional reforms. Okay, the Bank of Punjab stated, sorry, the Bank of Japan stated that business investment was likely to continue to increase. So investments by businesses is likely to increase, supported by expansionary monetary policy. As I said, interest rates are decreasing. Growth expectations are high, and increase in demand related to Olympic Games to be held in Japan, which recently happened in 2020. Didn't happen in 2020. Why? Because there was COVID, but they just happened few months back, I guess. Private consumption was expected to continue to increase as employee incomes continue to improve, right? Public investment was projected to increase during 2007, mainly due to government measures, and was expected to remain at a relatively high level after 2017. So this paragraph is explaining how the components of aggregate demand were expected to change in Japan. What is happening? The Bank of Japan said that business investment is high. So out of the 5 components of aggregate demand that you know, consumption, investment, government support, and exports minus imports, right? So these are the 5 components. Am I right? Right? So out of these 5 components, what is this saying? Investment is expected to be high, right? Supported by expansionary monetary policy, heightened growth expectations, and increase in demand related to Olympic Games, right? So investment is higher because of these reasons. Private consumption was expected to continue to increase as employees' incomes are improving. So employees' incomes are higher, so that's why consumption will also be high. Public investment, which is basically government spending, public investment was projected to increase during 2007 due to mainly of government measures and was expected to remain at a relatively high level after 2017. So these 3 measures of aggregate demand were expected to be high, right? Is everyone clear on this? Students, is this making sense? Right? Okay, now we'll move on and read the remaining case study. Meanwhile, other advanced economies were expected to continue to grow steadily, and a recovery in emerging economies was expected as a result of their own policy measures and the growth in advanced economies. Japan's exports were expected to rise as a result of improvement in economies of its trading partners and the depreciation of Japan's currency, the yen, right? So Arbab would remember we were talking about this exchange rate, in fact, yesterday in our AS economics class, right? So when you have weak currency, what happens, students? When you have weak currency, your products become more competitive. Isha, do you understand this? Right? So I can give you a very simple example of what is happening with Pakistan at the moment, right? So previously our exchange rate was approximately $1 equals, let's say sometime back 160 rupees or something. Now it has depreciated even further, and now one American dollar buys them something 172, 173 rupees, right? So our currency is getting depreciated. It's becoming weaker because with the same 1 unit of their currency, they can buy more units of our currency, right? So for them, our products are cheaper. So exports will increase, right? Exports will increase. Are you getting me? So the weaker a country's exchange rate, the more price competitiveness it gets, the more price competitive it gets, because just look from the other end. Previously, American used to give $1, and against $1, they used to buy goods worth 160 rupees in Pakistan. Now, for the same $1 that they give, they can buy goods worth 172 rupees in Pakistan. Yes or no? Right? So this means that our products will become more competitive. So what is happening over here? Japan's exports were expected to rise as an improvement in economies of its trading partners. Now, what this means simply that if USA is recovering, which is a major trading partner with Japan, USA will import more from Japan. What will USA import? I don't know, cars, consumer electronics, and other things, right? So since Japan's trading partners, economies were recovering, which means that now they will demand more of Japanese products. And secondly, because Japan's currency is depreciating, which is yen, right? Now the demand for Japanese products will be higher. Easy? Our exchange rate has fallen in this example. Yes, exchange rate had fallen, right? The example that I showed you. Yes, yes, correct. There was also an upward revision of GDP following a change in the calculation of GDP statistics. The projected financial conditions suggested that real interest rates were likely to remain very low. The real interest rates are likely to remain very low. Now have a look at this. So we are provided two graphs. On the left graph, which is figure 1.1, Japan's inflation rate, percentage change in CPI, consumer price index, which is used to calculate inflation. So if you can see, inflation rate was, positive, a little above 100, but then it went below zero. So when the exchange rate is going below zero, Arbab, what does this show? Anisha? So if the exchange rate, I'm saying, if the inflation rate is going below zero, what does it show? It shows deflation. This means that during these time periods, instead of prices increasing during these time periods, instead of prices being increases, pricings were decreasing. Prices were falling. What is deflation? Opposite of inflation. So in deflation, prices falls. So in this time period, prices in Japan were falling, where it's negative, below zero, right? What's the other graph showing you? So figure 1.2, changes in Japan's money supply, right? So percentage change in M3. M3 would be one of the measures of money supply. So you can see money supply is almost, except for this part, and except for this part and this part, right? So there is basically generally an upward trend. So there's an upward trend in money supply, which means between 2011 and 2016, right, the money supply of Japan was increasing, right? Is this simple, students? Any confusion? Right. So disinflation happens. Here, disinflation is taking place. Good question. Excellent question. This is disinflation. Why? Because think about this. Here you had 4% rate of inflation approximately. Then it went to drop down to 3%. Then went to 2%. Prices are still increasing, but at a slower rate. Prices are still, like, the price level is above zero. The price level in this case is above zero, but it's on the downward trend. So that is disinflation, right? Easy. Does it make sense? So for this part where inflation is above zero, right, but it is, downward sloping, this means that the rate of inflation is decreasing. That is what it shows. We good? Any confusion, students? Any confusion? Anything that's not clear? Anything you want to ask me? Right? Okay, perfect. Right. Okay. Now moving on, have a look at this. Identify two positive influences on Japan's economic growth. Identify two positive influences on Japan's economic growth. Okay. So what are the two positive influences? Who can tell me? Right? Identify. So the question is saying only identify. So just we will mention, we'll not explain in detail. Quickly. Yeah. Aggregate demand is increasing. Yes, totally. I was about to say the same, right? So aggregate demand of the economy is increasing. Just think of a country that is recovering from deflation, right? So think of a country that is recovering from deflation. So don't you think it would be better if its aggregate demand increases, right? So deflation means that the prices were decreasing, and deflation is, mind you, deflation is not healthy for an economy. Deflation is never healthy for an economy, right? You would know, right? So if a country is recovering from deflation, aggregate demand increase in aggregate demand is a very healthy prospect for an economy. Why? Because that would mean that now relatively demand would be higher and your GDP would increase and your price level will also increase, right? So if this was your original equilibrium point, with this much your general price level and this much was your real GDP. So now if the aggregate demand of the economy increases, so this is Y1 real GDP. Now, if your aggregate demand is increasing, it's shifting to the right, right? Like this, aggregate demand is shifting to the right. right? So that would mean higher general price level, which you definitely need because previously your country was facing deflation, and that will also result in higher real GDP, which is again something positive as national income is increasing, right? Easy. Right. Sure. Right. So what are two positive impacts? Think about identify two positive influences on Japan's economic growth. Positive influences on Japan's economic growth. Aggregate demand is increasing and the real interest rate is low. The real interest rates to remain very low. Because when interest rates are low, what happens, students? When interest rates are low, what happens? You are borrowing more, consuming more. Yes or no? Am I making sense? So there will be more aggregate demand. Or you can also talk about supply side policies. Since the country is also implementing supply side policies, right? High investment, exactly. So is everyone clear on this? So students, even supply side policies is a good thing because what happens when there is a supply side policy being implemented, your aggregate supply shifts to the right. When your aggregate supply shifts to the right, again, the good part is that your country's GDP is increasing. Your country's GDP is increasing. So you could have mentioned any of the two. You could have mentioned any of the two. Any two of the things that are taking place in the economy, right? So either you could have talked about the supply side policies, or you could have talked about quantitative easing, which is basically low interest rates, or you could have talked about increasing aggregate demand in the economy, which is all of this paragraph. But you just need to mention, no explanation, no nothing. The next question says, to what extent figure 1.1 and figure 1.2 support Friedman's view that inflation is always and everywhere a monetary phenomenon? Exactly what we just discussed, right? So Friedman was the person who developed the quantitative theory of money, right? So according to this Friedman, the monetarist economy, inflation is always and everywhere a monetary phenomenon. That's what he said. So it is asking us the question that to what extent it supports the claim based on the diagram that we have. Yes or no? Students, are you following me? Okay, now let's see. Now here we need to be particular because it's a 5 marks question. So in 2012, where's 2012? 2012 is over here, right? So there was money supply. Let's have a look at this. Money supply in 2012 was a little on the downward end. So it was on the downward end. Do you agree with me? And inflation over here was a little positive. Then in 2013, the money supply started to go up. So if the money supply is going up, inflation should also go up. But in 2013, you can see inflation was going down. It was deflation. Students, are you following me how I'm looking at it? Because Friedman said that money supply changes causes changes in inflation, that is what the question is asking us. That is what the question is asking us. Think about this. To what extent, sorry about that. To what extent figure 1.1, students, are you with me or not? To what extent figure 1.1 and 1.2 support Friedman's view that inflation is always and everywhere a monetary phenomenon? Like inflation always takes place due to increase in money supply. So the question is saying to what extent the data in the case study is supporting it. So now what you need to do is to compare what is happening to money supply, which is shown on the right graph. And based on the money supply, you need to see what is happening to the inflation in the country. So what should happen is basically that if money supply is increasing, that should increase the price level and vice versa. If money supply is increasing, the price level that we just discussed in quantitative theory of money. Money supply is increasing, price level should increase. And on the opposite, if money supply is decreasing, the price level should decrease. Easy? Is this simple? Any confusion so far? Right? Okay, now students, have a look at this. So in 2012, because this graph starts from 2012, so do not make this mistake. In 2012, between 2012 and 2013, if you see the money supply is increasing, money supply, there's an upward trend. Yes or no? So what should happen? What should happen to prices? Prices should also increase. So between 2012 and 2013, 2013 would be somewhere over here, right? The prices are falling. The prices are falling. There's deflation taking place. Yes or no? Then in between 2013 and 2012, uh, uh, the money supply is decreasing. The money supply, it's a downward sloping trend, yes or no? And between 2013 and 2014, the prices are increasing. Again, going opposite, yes or no? Then between 2014 and 2015, the money supply is increasing. So inflation should also increase. Between 2014 and 2015, yes, a little bit is true because the prices are on the upward trend. And then between 2015 and 2016, money supply is kind of decreasing and then increasing. And in this case, it is completely, prices levels are also decreasing, right? Are you getting me? So what we understand out of this, long story short, what we understand out of this is that it is not neatly following the pattern. So changes in prices cannot be fully explained by the changes in the money supply because the two are not always going in the same direction, right? You have to compare the two graphs. Yes. Isha, did you get this or not? So students, the purpose of explaining this was that you need to compare the two graphs year by year because this is a 5 marks question, right? It's a 5 marks question. So you have to compare the two graphs together. And as I was telling you, what you need to do is you need to look on the right side of the graph, which is showing you the changes in money supply, and then tell whether the changes in prices in the country can be explained due to changes in the money supply, right? Yes or no? Yes or no, right? So then you would say, just give me a second. Is this simple, students? Any confusion, anything that's not clear, right? So you will explain year on year movement, and then you will tell that in some years, yes, higher money supply is causing higher price, but in other years, it's not going in this direction. So we can't really say that the changes in money supply are the only reason that explain inflation in the country. So we can't really say that the changes in money supply is the only reason that affects inflation in the country. Is this simple, students? Okay, now let's quickly try to wrap this up and then we will continue tomorrow if there is any other confusion, right? So what is the C part saying? Explain the likely impact of quantitative easing on Japanese economy. So you just need to briefly tell what is quantitative easing. So you can explain a little bit about the concept that I explained you over here. I said that quantitative easing is, where the commercial banks are buying back the government bonds and therefore more money becomes available to the banks and they issue more loans. When they issue more loans, interest rate drops, and that is what quantitative easing is, right? So you can explain that and then you will tell that what will that do to the economy, right? So basically for this question, you just need to talk about that what lower interest rates do to an economy, what lower interest rates do to an economy. That is all what you're supposed to talk about, right? So for that, you will say that lower interest rates will encourage investment. People will borrow more, they will invest more. Right, exactly. More consumption, people will borrow more and buy goods and services that they need, buy a new car, buy a new house, right? Things like that. Then what else? What else? If interest rates are low, perhaps, your exchange rate will also become weak. Why will your exchange rate become weak? Because people will move their money out of Japan. People would not want to invest in Japan because interest rates are so low. So they will want to move their currency out of Japan to other countries to invest and so on. When the cash outflows take place, when cash money is flowing out of Pakistan, out of Japan, right? So the demand for currency supply increases, the supply of currency increases and its exchange rate becomes weaker. And therefore your currency becomes weaker. And that is a good thing in a way because your products become more competitive. Right, right? Did you guys get the last part? Right? So think about this, students. When interest rates hot money, how does hot money flow? Hot money flows or chases higher interest rates. So hot money is basically portfolio investment that people put their money in, different countries' bank account or different countries' stock exchanges, right? So that's hot money. So higher the interest rates, higher the higher the interest rate, the more investment will be made in that country. Now, interest rates are low in Japan, so people will move their money out of Japan. So when you move your money out of Japan, what happens to your exchange rate? So let's say this is dollar per yen, right? And this is showing you the quantity of yen on the x-axis. So when yen will, right? So downward sloping is the demand for yen, upward sloping is the supply for yen. So when people are moving their money out of Japan, they want to invest in some other country, right? So supply of yen on international markets will increase. The supply of yen on international markets will increase, and therefore it means that now yen has become weaker against dollars. But that is a good thing. Why is that a good thing? Because your currency is getting weaker, and that is what the case study was talking about, right? So your that will become weaker, right? And exchange rate will become weaker, which means you will be able to export more, right? Depreciation of Japanese currency, right? So this is all what you need to explain. Last question, discuss the possible effects on the Japanese economy of the changes in supply side policies and international economic events described in the article, right? So you have to talk about, discuss the possible effects, both positive and negative, possible effects on Japanese economy of the change in supply side policy. What supply side policies actually does, it increases the money, it increases the aggregate supply in an economy, which means that now a country is able to produce more output. And with that happening, the country's GDP increases and its inflation decreases. Yes or no? Right? So what happens when the aggregate supply of an economy shifts rightwards? So you have real GDP on the x-axis, you have general price level on the y-axis, downward sloping is your aggregate demand, upward sloping is your aggregate supply, right? And what it does actually is that it shifts your aggregate supply rightwards. With that, you can see for yourself that the real GDP in the country would increase, rightward shift on the x-axis, and your general price level also falls. So that's a positive effect. So that is one thing that you need to explain. After that, right, all factors, yes, all positive and negative, because the question is saying discuss. That's your hint. So when the question says discuss the possible effects on Japanese economies in supply side policy, so you have to talk about both. But in supply side, there's no negative aspect involved, right? So it's both positive, and inflation is getting controlled and the country's GDP is also increasing. So both are positive. But for other international events, what were international events? That your trading partners' economies are recovering. That's again a positive thing. Countries' currencies depreciating. I think that's also a positive thing, right? There's Olympics taking place. That's also a positive thing. The only bad thing that can happen out of all these things, that in the longer run, that can result in inflation in the country, higher rate of inflation, right? Because at the moment, they're just focusing on fighting deflation, but with all the increased economic activity, increased exports and increased government spending and increased investment and increased consumption, that will result in higher price level, right? But that is what you need to talk about. Is this clear? So students, I would have to run. There's a meeting that is waiting for me, right? So tomorrow again, I'll try to have inshallah a longer session, and then we will see where it goes from there, right? Is it simple? Right? So I'll see you tomorrow. Take care. Have a good night. And tomorrow we'll also have AS class. Take care. Allah Hafiz. Allah Hafiz.